going to be a busy one with everything from GDP to, of course, earnings. Collin Martin and Michelle Gibley joining me. What about the international side, Michelle? What should we be keyed into when it comes to the rest of the world?
Yeah, so this week we've got some big releases. We've got inflation in Tokyo. It actually is a leading indicator for the national figure that comes out a couple weeks later. Core inflation is expected to hold above 2%, and it could give the BOJ room to hike rates at the end of this month, but there's still a little bit of uncertainty as to whether they're going to be pursuing QT versus a rate hike. We've got Bank of Canada this week, and they could have a second rate cut in a row after inflation weakened and unemployment rose last week. And then we have the PMIs. Those come across the entire economy, global economy. And, PMIs took a breather in June as services and new manufacturing orders slowed. So investors are going to be looking to see evidence that the soft landing is still the base case.
Okay. And soft landing here, obviously what we're hoping for. Should that mean, Collin, that we hope for some higher yields by the end of this week? Maybe a reflection of a good GDP number, something that's not hard landing?
I don't think so. I mean, yields, maybe they trade a little bit from here, bounce around, but we think the trend will ultimately be lower. If you look at what we're expecting this week and what consensus expectations point to, it is a soft landing. Expectations are for GDP growth to come in at 2%. That's right on trend. It's not too hot, not too cold. We're going to be focusing more on Friday's PCE report. It's the Fed's preferred inflation gauge, and we're looking for and hoping for another low month-over-month number. After last month's 0.1% gain, market expectations are for a 0.2% gain. That's certainly a step in the right direction. And if you look at that important year-over-year number, it's expected to drop to 2.5%. That in the Fed's eyes is moving in the right direction. That's what they've been focusing a lot on. They want to see it consistently move in that direction. But I think, interestingly, the Fed's median projection is for a 2.8% end-of-year number, and expectations are for it to be 2.5% just at the end of this month, or when we get Friday's number, rather. So I think that'll be interesting. Powell kind of highlighted the risk of base effects as it relates to core PCE, but I think it's interesting that if it comes in as expected, 2.5% year over year is certainly a step in the right direction.
Okay. Now, odds of backed a tiny bit off the 100%, but we're still pretty much there for our own expectations, according to CME. Michelle, we talked last week, though, as far as Europe goes, maybe Canada, too, not quite as clear that they're cutting next, right? We might get a pause here the next couple of weeks.
Well, yeah. So last week, the ECB kept rates unchanged. And they said that September's wide open. And, that's despite sticky services inflation. But the impact there is wages. So we get union negotiation cycles that some of them are 1 year, some of them are 2 years, some of them are every 3 year. So the German public service employees just got their first for their first wage increase in 3 years. And so, the ECB believes that wages will peak this year, wage growth will peak. And so they are confident that they're going to get to 2%, but there could be a little bit of bumpiness along the way. The Bank of Canada, markets went from 50% probability last week to now 90% probability that they'll cut rates this week.
China, though, to go to the other side of the world real quick, are making some more stimulative efforts, right?
Yeah, China cut rates last night. The problem is that the cost of money isn't really the problem. I mean, China's economy is slowing due in part to weak confidence by businesses and consumers. And so far, they've really focused their stimulus on boosting supply. But last week, we did get a little bit of a positive, a surprise reference to the near term in what is normally a long-term meeting, the third plenum. And it suggested that they could increase demand by giving support to local governments to fund purchases of durable goods for consumers to purchase durable goods, and that would boost GDP growth potentially this year.
Okay. Any blowback effect if China really starts ramping up, Collin, or is the movement for our own, the catalyst for our own bond market pretty clearly Fed-related, GDP-related this week?
Yeah, I think it's very much domestically focused. Obviously, what happens overseas matters here, but we've seen enough momentum in the various parts of the economy that suggests that the next move by the Fed will be a cut. We're not expecting much next week at this meeting, or next week's meeting, rather. We don't get any updated projections. It's unlikely that Powell makes a clear signal about what could happen in September. For that, we'll probably have to wait for the August Jackson Hole meeting, where maybe that's probably when they'll provide the signal. The Fed never wants to surprise the markets. They want to make sure they're laying the groundwork. So Jackson Hole will get that. But just in terms of the economy, we're seeing plenty of signs that the labor market is coming more into balance. I think that's going to be the key to bringing inflation down to that 2% target. We're seeing initial jobless claims remain elevated, continuing claims at their recent peaks. Unemployment's trending higher. Wage gains are slowing. I mean, you name it, we're seeing those cracks in the labor market. Not huge cracks, but enough to slow down spending patterns, spending behaviors, and enough to bring that inflation number back down.
Okay. Big week on Thursday, and then, of course, inflation Friday, too. Great setup. Appreciate that. Michelle Gibley, Collin Martin, good stuff.